Welcome to Thoughts on the Market. I'm Chetan, Ahya, Morgan Stanley's Chief Asia Economist. Today on the podcast, with the Republican White House now in place, tariffs are the key issue that will matter to Asia. It's Tuesday, November 12 at 2 p.m. in Hong Kong. With the US election results in, the question now is not if there will be tariff hikes, but when and how much. Will China alone see rising tariffs, or will there be universal tariff imposed on all imports to the US? The previous President Trump administration imposed several tariffs on Chinese imports beginning in 2018. And looking back, our learning is that weaker corporate confidence weighed more heavily on Asia's growth outlook than the direct effect of tariff on exports. Just to elaborate on the point on direct impact of tariffs, despite the tariffs being imposed on China during that period, what we observed is that China's market share in global goods exports improved after the US started to impose tariffs on imports from China. Looking forward, let's consider a scenario of 50% tariffs on China alone. The hit to global and China corporate confidence may not be as large as it was in 2018 and 2019. This is in part because US-China trade tensions have persisted for several years now. Companies have invested in diversifying their supply chain since then, and the US share in China's exports has declined since 2017. Given all this, the drag on China's exports may be less than 1 percentage point that we saw last time. The rest of Asia would also experience a slowdown, but we think the overall drag on growth would be less significant this time. The effects on individual economies would differ based on their exposure to China. We think Australia and Indonesia will be more exposed. Korea, Taiwan, Malaysia, and Thailand would be moderately exposed. And India and Japan would be less exposed given a low share of exports to China. But what happens if the US imposes 50% tariffs on China and a 10% universal tariff on the rest of the world? In this scenario, the damage to corporate confidence and the global capex and trade cycle would be much larger. The drag could be similar or greater than what we saw in 2018 and 2019. Asia, excluding China, has now become more dependent on the US as a source of end demand. Global supply chains might have to be rewired yet again. This would cause a significant disruption to the corporate sector and a material impact on Asia's growth trajectory. Of course, the final effect of US tariffs on Asia growth would also depend on the scale of policy support. Asia's policymakers could allow their currencies to depreciate in response to a strong dollar. Then, against a backdrop of weaker currencies, Asia's central banks could be constrained in their ability to cut rates immediately, similar to what happened in 2018-19. Hence, they would prefer to take up fiscal easing first. Back in 2017-19, Asia's fiscal deficit widened in aggregate by 1.1 percentage point as policymakers sought to provide some cushion to growth downside. Once currencies stabilize, they will take up monetary easing. Things may move quickly once Trump takes office in January, and we will continue to keep you updated. Thanks for listening. If you enjoyed the show, please leave us a review wherever you listen and share thoughts on the market with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.